a doji, then another doji. Notice that the market goes up, probably hit a lot of stops. The prior high here was knocked out. Someone got stopped out, and we have a low close doji trigger. At this point, we're sitting here trading at 130.53. Now our risk is up here at 130.70 on a stop close only. At this point, you may say to yourself, that must be too much risk for me for too many positions. Then scale back your positions. If you're a 5-lot trader, move it down to a 2-lot, but at least you'll capture a portion of a trade signal without missing an opportunity. Now, I would gather to say with this high and when that high, just based on the relative formula of stochastics, which we will get into, that this was forming a bearish divergence pattern because the market did what? It made a higher high but failed to maintain and sustain that high, and it closed closer to the low. It closed below the prior time period's highs as well. And then, of course, we see negative momentum by a lower closing low than the doji. That's your trigger to go short the market. Here's another example of the low close doji, especially using our stochastics. Notice here we have the doji. We have a low close doji. The market, the very next candle, does not close below the doji low, but it does so here. Notice that our Genesis software package triggers a sell for us. So we're alerted by a orange arrow pointing down that we have a sell signal. We identify the doji. We see the market looking at closing below both moving average crossovers. We see the market closing below, of course, the moving averages on top of it, and we have a beautiful setup and a sell signal all the way down. This is a nice scalp for short-term traders. This is the kind of trade we look for. Now again, these patterns reoccur frequently, all the time. The key is we don't know what the end result will be. I don't know if, for example, this is a euro currency. I don't know if this is going to be from 119.40 fall all the way down to 118.92. I mean, obviously, we have a 48 pip drop, and this is based on 20 minutes. So we have what? From the close to the open, 1, 2, 3, 4, 5, right? 100 minutes, 6, 120 minutes. We have to stay in that trade for over 2 hours as we enter near our pivot support. Here we have a higher close. That's where we want to start exiting our trades. Or again, as we get closer to our pivot support. Now, one thing that we didn't talk about yet is stochastics. But I did say how you can utilize stochastics or MACD to help confirm these signals. Notice that the stochastics has a nice hook cross signal below the 80% line and confirms that there's a shift in momentum weakness. That is a beautiful setup and a perfect textbook trigger to go short a market. Your risk from the point of entry, which is either on the close or the open, which is at 119.50, we're risking a stop close only over 119.75. So that's literally 25 pip risk. And so we want to have at least a 2 to 3 to 1 risk reward ratio. And by the way, that's exactly what we have here, about 50 pips to the downside, risking 25. Now the key is, when I talk about initially a stop close only, let's define initially. As soon as I get into the trade, I want to make sure that if it's not the next time period, by this close or the next close, I need to see immediate results. The further the market moves from my initial entry, which is right here, I can change that from a stop close only, and now I can change it to a hard stop, a regular stop. Change it to a regular stop, okay? Instead of a stop close only order. We initially place it as a stop close only. As the market starts to prove and decline in our favor, we move that from a regular stop to a stop close only. Now we can start looking at what? Moving our stop down to break even. As we start to see the market do what? Perform quite nicely for us. If you're short, what do we want to see? We want to see the market close below the open. We want to see red candles, correct? And that's what we see here. Those would be negative assigned candle. What's this? A green candle. That's showing us that there's a shift in momentum, that the negative momentum is starting to wane. We're starting to see a conditional change in the market, and it's time to possibly tighten stops, scale out of half your position. By the way, if you notice that this candle right here, This red candle is the last conditional change candle. I say last conditional change candle because notice where it closed